Welcome to this week's Market Watch. I'm Robin Hart with the CMG Home Loans team, and today we're cutting through the headlines and looking for the signals that actually matter: mortgage rates, consumer debt, inflation, jobs, the Fed, and what's really happening to home values. So let's dive in. All right, first, mortgage rates. Rates moved higher recently, putting pressure on mortgage demand. Now, here's the thing to remember, and the most important rules in mortgage finance: rates don't actually wait for the Fed to move. Mortgage rates respond every single day to inflation expectations, economic data, geopolitical risk, and especially the bond market. So instead of obsessing over one day's rates, watch the overall trend. The current trend are that rates are going up. Now, we're also seeing that play out right now. Earlier this week, bond yields and mortgage rates pulled back as markets reacted to changing geopolitical risk and inflation expectations. We also saw Treasury Secretary Scott Bessent expand Treasury buybacks, which added liquidity to the bond market and helped ease some of the pressure on those long-term yields. That's important because the Fed funds rate and your 30-year fixed mortgage rate are not the same. Mortgage rates are heavily influenced by the bond market, and bonds can move long before the Fed ever changes policy. That's the signal in the noise. So here's one of the strangest parts about today's economy: Americans are being squeezed. You see, Americans are actually carrying substantial credit card, auto, and student loan debt. And while millions of homeowners are simultaneously sitting on the silent wealth builder called significant home equity. So we increasingly have households that are wealthy on paper, but squeezed out every single month by cash flow. And that's why homeowners shouldn't just ask, "What's my mortgage rate?" They should also be asking, "What's the cost of all of my debt?" So sometimes the bigger financial opportunity is restructuring the balance sheet, which you hear from a lot of companies and on a lot of financial news. Next comes the Fed's balancing act. You see, they need inflation moving toward the target rate of 2% without damaging employment. So when inflation cools and job growth softens, bonds often improve and mortgage rates benefit. But stronger inflation and employment data can send yields and mortgage rates right back up. And that's why one economic report rarely ever tells the full story. So, who actually controls your mortgage rate? Well, there isn't one magical person sitting behind a giant mortgage rate button. The Fed actually controls short-term monetary policy, while the Treasury policy affects government borrowing and bond supply. Then investors continuously price in inflation, growth, and risk into the Treasury and mortgage-backed securities. So mortgage rates are actually a result of all of those forces interacting. That's why mortgage rates can move even without the Fed when they're doing absolutely nothing. Now, to housing. Are homes actually losing value, or are we simply just giving back some overinflated expectations? You see, new home sales have weakened, inventory has grown, and builders are competing more aggressively, and buyers have more choices. But that doesn't actually mean or automatically mean we're watching a housing collapse. It actually means that price matters again. Some markets and properties are correcting more than others, like Austin, Texas, or Florida, and sellers can no longer automatically expect yesterday's price plus another 10%. This looks a lot more like a reality check and repricing than one giant national housing story. Which brings us to our meme of the week: the seller who thinks it's 2021 and the buyers who want the apocalypse to happen now. So buyers currently have choices again. So sellers: presentation matters, condition matters, marketing matters, and above all, price your home for the market that you're currently living in, not the market that you miss or bought in for that matter. And here's the bigger lesson: don't make a 30-year financial decision based on a 30-second headline. Markets change, rates change, headlines definitely change. Your financial strategy should be based on your numbers, your goals, and your timeline, not whatever scared everybody on television this morning or on Facebook. So, what's my takeaway this week? Your finances are unique. Whether you're buying, refinancing, or investing, start with the conversation. Look at your income, payment, debts, equity, goals, and timeline. Because an uncomfortable market can sometimes create a very comfortable opportunity. Whether that's buying better, investing, or restructuring the expensive debt. Now, I've been doing this for 26 years, and markets like this are exactly where experience and strategy matters. My job isn't to convince you to go out and get a mortgage. It's to help you determine whether the numbers make sense, and if they do, find the financing strategy that fits what you're trying to accomplish. I'm Robin Hart with the Home Loans with Heart team of CMG. Build smart, build wealth, and go and enjoy the good life. I'll catch up with you soon.